I think it's just a case of being patient. And personally, I've never been a great timer of the market.
No, not many,
Yeah.
are they?
Yeah. And we can come and talk about this when we talk about the illuminator. I tend to do the drip feed into the market. You buy small amounts of stock every month, etc.
Yeah.
And you try and find good quality names, which are going to stand the test of time. And over a number of years, your returns will be good.
Welcome to the Fund Your Retirement Podcast, a guest-led podcast aimed at sharing insights and strategies to help you build long-term wealth. Today I'm delighted to introduce Neil Shah. Neil is the Director of Research at Edison Group, an investment research and advisory company with over 80 investment analysts. During this conversation, Neil shares the macro view of the UK share market, including many insights from Neil's extensive network of fund managers. Neil shares some of the best and some of the worst performers from Edison's model portfolio, the Illuminator, which has returned over 1,300% since 2008. Neil goes on to discuss some of the metrics that his team look for before adding or removing a company from the portfolio and how he improves those analytical skills over time. And finally, Neil gives an in-depth review of what Edison Research does and how this can be a benefit to the wider investor community. Neil was a fantastic guest, sharing some valuable insights that will be of benefit to the experienced investor as well as the new investor. I hope you enjoy, and let's get started. Hello, Neil. Thank you very much for joining us today. Really appreciate you coming on the show.
Pleasure. It's my first time, so looking forward to it.
So have I, Neil. So what I like all my guests to do is to start off with a little bit about their journey, their background. So if you can take that away, Neil, that'd be absolutely excellent.
My background, I was a sell-side analyst at a bulge bracket bank, spent a little bit of time on the buy side. And for the last 19 years, I've been at Edison, where I helped build the research product. My job is to make sure we're writing good quality research. Behind that is hiring the right kind of team, putting in place the right kind of philosophy, and also the right kind of systems and processes. Over the last 5 years, actually, my title changed from Director of Research to Director of Content and Strategy. And part of the reason for that is that the way we consume information has changed. And it's research, if you think about it, is not just a document. It's much more now. It's all the different content types, from video, audio. We write much more in the way of thematic research, short form research. We're catering for a wide demographic of users who like to consume information in different ways. We try and put it out in different formats for them.
Yeah, it's been a big shift over the years, haven't there? We've gone from the written word to the video, and here we are now.
Exactly. Speaking
on
to each
audio.
other.
Yeah, podcasts.
Yeah.
So
Yeah.
I'm sure there'll be an involvement after this as well. What I thought we'd start off with is a bit of the macro view, and then we'll drill it down to the Illuminator portfolio that you have there at Edison and then some
Sure.
individual stocks. So what's your thoughts then on the current situation for private investors in the UK?
I speak to lots of fund managers and they will outline the fact that there's a lot of value in the UK market. It's not universal. You've got to look carefully, and there's pockets or sectors where things are very attractively valued. Other areas where you might argue it's either fairly valued or still a little bit pricey. The main concern, I think, that's in the market, it feels very directionless right now. It's almost like we feel like we're in the eye of the storm. The levels of volatility we've seen in the market have been very low, and there's an anticipation that actually as you get into the second half of this year, you're going to see more volatility coming through. What's the concern? Well, I think the general consensus is that inflation is starting to roll over, and with that, the rate cycle will start to roll over. However, my own view is that it's going to be a little bit more sticky than people think. Energy prices are going to come off, but if you look at food components, these are structural things which actually need supply chain reform to really start to see a shift in the price. And on top of that, you've got the wage inflation starting to come through as well. So I think inflation is going to be a little bit stiffer than people might expect. And accompanying that, there is a real concern that as we go into 2024, the big debate is, does the US move into recession? If the US moves into recession, everywhere else follows. I mean, I don't think this is catastrophe. It's not like the global financial crisis, but there's a view that you could actually pick up stocks cheaper if you wait. And so I think there's a little bit of timing going on in the market. It doesn't bode well for the second half. You've seen a lot of stocks taken out, acquired over the last 6 weeks, etc. And that to me is a clue that there's a reasonable amount of value in the market. But I still am concerned that maybe earnings forecasts are too high. I think you are seeing people being cautious before they enter into the market. And I don't think that's going to curtail also the supply of new companies coming into the market. I think the IPO market is going to be relatively subdued in the second half of this year as well.
You said something interesting there about a lot of companies being taken over. Do you think that's something that we'll continue to see throughout this year?
I do. I mean, I think there's a difference between public markets and people who are looking to time entry positions. I think, I run you off a raft of fund managers from Gervais to Richard Penny to the guys at Gresham. Richard Staveley was talking to me about it. And there is this general feeling of the UK market is extremely attractive on a relative basis. And on a 3-year view, you're going to do really well. I think it's just a question of timing the entry into that market. However, if you're private equity and you're taking a 5-year view and actually don't care about the near-term volatility, etc., I think it's fine. You're going to step in, and I do think that you will see more bids coming in and companies being picked off. And I think it's a real concern for a lot of listed companies, which is they have put a lot of work to turn their businesses around post-COVID. They're in the transition phase. They actually want to see the fruits of their labor rather than being acquired.
Yeah, it's a good point. I guess with your network of multiple different fund managers you get to speak to, you do get a lot of insights into what they're thinking in terms of how they're deploying their capital. And are you seeing a lot sitting in cash at the moment themselves and waiting?
A lot of them are prepared to invest at the right moment. That you do see people finding entry points in stocks that they really like, but there is a sense of caution in terms of really getting into the market. And I think we need to get past the summer first before you really start to see people participate actively. I do think naturally the market's going to find a floor because you've got all these people who are thinking it's really attractively valued. It could get more attractively valued. That's my entry point. If you start to see prices come off, you will start to see people starting to come in and buy. I think it's a case of being patient. And personally, I've never been a great timer of the market. And we can come and talk about this when we talk about the illuminator. I tend to do the drip feed into the market. You buy small amounts of stock every month, etc. And you try and find good quality names which you get to stand the test of time over a number of years. Your returns will be good.
Yeah, great point. And also great segue into the Illuminator fund, which you launched with Edison in 2008. Was it 2008, I believe? Yeah, you launched right at the depths of the financial crisis, which arguably is a good time to launch a fund. And since then, it's delivered 1,300%. Yep, 1,300%.
Slightly more than that. I think I don't know the roundings around it, but it's about 1,300 compared to the old share, which was up 158 or 160%. So it's had stellar performance.
Done well
since we launched it. Yeah.
Yeah.
It's a model portfolio, so it's not active. We're not running a fund or anything like that. Yeah. But the origins of this was actually in my sell side days, I came across someone who managed private wealth money. And it's this idea around an efficient market, which is you're only going to make money if you know something more than the rest of the market. And he had a very simple approach. And, I was young and impressionable. I learned my trade from him, which is that he couldn't tell me whether one tech company was better than the other, or one healthcare company was better than the other, or indeed one miner was better, or this deposit was better than the other. But he did say that, look, I do know the attributes of a high quality company. And it's pretty simple, which is that if you think about the classic company, it's got a product or service which consumers or businesses really love and depend on, and they keep buying it. So there's that recurring revenue coming through from it. They've got a lot of capital discipline in terms of how they grow, and they're growing faster than GDP. They're delivering earnings faster than GDP. They're generating return on capital, which is high, return on equity, which is high, which means that to fund their growth, they don't need to keep coming back to shareholders. You've got management teams who should be acting in the interest of shareholders. Leverage is important. You need to have, I don't think leverage is bad. You want to run an efficient balance sheet, but you don't want to be over leveraged so that you've got resistance in the cycle. So it's starting to identify the things that you would look for in a high quality company. And actually, as a sector analyst, I used to run effectively proxies for those kind of things, numerical proxies for those, to compare companies in a particular sector, which used to lead to my range of here's what I'm a buyer and here's where I'm negative on a company. When I came to Edison, we wanted to have a tool that provided us a view in terms of which stocks were interesting to the market. And so I built the screen in 2008. What it tends to do is it picks up companies quite early on in their sort of growth trajectory. It's very patient. It tends to hold on to companies through that, so it doesn't sell them too early. and it's relatively low turnover. So the model portfolio's got 10 stocks in it. We would typically see that one would drop out once a month and be replaced by something else. So relatively low in terms of its turnover. We publish it. It's got a fully auditable track record, and we're still running it today. And it throws up some interesting names. So today, I can give you a sample of the names. So the 10 that we currently run are Kainos, which is an IT company, Serica, and I can talk a little bit more about that. Softcat, YouGov, Rightmove, Spirent Communications, JD Sports, EMIS, which is in the process potentially of being taken over, Gamma Communications and Computer Center. And all of these companies, we have run effectively numerical screens for the attributes we're looking for. And that's the secret sauce, so we don't share it too widely. But these are the companies that we currently have in the portfolio. And some of them have been there for a very long time. So Rightmove has been there for a decade. Some new, I mean, it's been around for maybe a couple of years in the portfolio.
That's brilliant. 10 companies, that's quite concentrated, would you say, as well?
Yeah, it is. The screen actually runs longer. There's a market cap cutoff. We don't tend to look at things below 50 million. It's got 600 names, which we rank. The original sort of screen that I run, people have tinkered with it. It's never beat the actual original screen.
Yeah.
And what you find is that you can invest in 20 stocks or 30 stocks, but actually you end up getting slightly diluted performance. Not massively, but so you can diversify away. But actually the concentrated portfolio, it leads to the returns that you see.
Yeah, and having spoken to quite a few private investors on this podcast now, the different approaches, some have concentrated portfolios, 10, 13, 14 stocks. Others have a broader 30 to 40 to 50 even. I think that comes down to personal style and preference. But as you've said, the concentrated ones, if you get it right, the returns can be obviously far more outsized than the broader one. You mentioned some companies there you've had for a long time, say Rightmove, for example. How did you come across that in the beginning that's done so well for you? Without obviously sharing your secret sauce, but
it's like most things that you run a screen on numbers. And actually what we do is that we then rank companies. For example, I mean, the obvious one is we'll take a look at 3 years earnings growth, for instance, and we'll rank every company in 3 years earnings growth.
Okay.
It really is a numerical proxy, effectively, of saying, okay, based on that, here's the top 10 names in the market. So then what happens when something comes into the portfolio? We're analysts, right? So we take a look at it and understand the rationale for it showing up. And occasionally, once in a blue moon, something will be in there where we will actually override it or correct for it, either because we think that the analysts haven't correctly got the view right on this. But Rightmove is a classic stock. It's dominant market share, really big moat, effectively, to protect its returns. Fabulous margins. It's playing into this idea that our lives are digitizing, and hopefully everyone knows what Rightmove is, which is if you look for a house, you probably come across it. And I just think that it's stood the test of time, mainly because it's got such a strong position in the market. But also, I mean, they continue to innovate and drive the business forward. So nuances around it might be that while the original sort of business was based on house price sales, data around housing and house price sales, much more in the sort of rental market now, much more exposure to the rental market, much more in the short-term rental market. I also think the advent of AI is going to be interesting for Rightmove in that if they get it right, they will be able to serve up much better sort of personal recommendations. I am one of those people who have probably sat on the sofa for hours surfing through properties when we want to move or something like that. And it would be great if there was something that actually said, look, based on the things that I know you want, etc., here's some recommendations.
Yeah. It saves time, doesn't it? And that's what it's all about, isn't it? Saving time, efficiencies. So if we fast forward to today, then have you got a couple of companies that you may want to share that it's thrown up?
Yeah, so the other company, which I think is really interesting, is Serica. And sometimes the illuminator will pick stuff out, which is really against the sort of grain of sort of conventional thinking. So Serica was coming in probably a couple of years ago. And if you remember a couple of years ago, no one wanted to touch the energy sector. It was on its knees mainly because of this drive into it's not sustainable, etc. I think clearly there's a bit of maturity in the market in that we all understand that even if we want to go through that transition, we still have energy needs and we need to be sensible in terms of how those are delivered. The fascinating thing about Serica is it's been on a P of 3 or 4. It throws off fabulous cash flows from its oil production. You're getting your regular dividends, quarterly dividends coming through from that company. I think they've tried also to try and keep a relatively low profile from a market's perspective, just because of the windfall energy tax, etc. So for a lot of people, it wasn't one of those sort of go-go stocks that you'd see everywhere. The management team, I think, have been relatively cautious in terms of promoting the story, but the numbers do the talking for it. It's just this fabulous sort of cash generative piece. And I think at the end of December, it then raised some money and bought Tailwind, so it consolidated its position as a producer. So now it's a top 10 producer. And so a company that really strong sort of cash flow generation, you're going to get growth now going into the next couple of years. So it's a company I really like, mainly from the sort of valuation and sort of cash flow generation perspective. And ultimately, a PE is just telling you that this is how quick your money is going to be paid back in earnings, right?
Yeah.
4 times is pretty exceptional.
Yeah, that's good. Yeah, really good share that. Thank you. You mentioned as well, the screener will churn out a number of companies for you to look at, but then the analysts will then do the overview and then decide whether it goes into the portfolio or not. Is that correct?
Yeah. We don't leave things just to machines, etc.
Yeah.
I think there's got to be a human layer overlay. And I will give you a real example of this. Was at one point in the illuminator, it's one of the rare interventions we've had. Connor came into the screen and we were starting to take a look at it, and almost a month after it got into the screen, it had a profits warning. And my analyst team said that, look, if it was a high quality company, actually you wouldn't see this kind of earnings surprise from it. And we pulled it out, and hindsight's a beautiful thing, but actually we pulled it out, and a year later it filed for administration. And what was happening was that there was some very aggressive forecasts being put into the market, which were never going to be delivered. It's why you and I exist, which is we're great believers in do your research, right?
Yeah, exactly. Yeah. How do you improve the analyst's skills and behaviors for them analyzing stocks? How do you make them better over time? Because the fund has returned exceptional returns, and as you've said, they're heavily involved in the decision-making process for the stocks that go in and come out. So how do you make them better?
There's a methodology that we run. I have a number of young analysts starting at Edison and going through that career journey. I mean, I think you've got to get the basics, basic knowledge of accounting so that you can navigate P&L, balance sheet, cash flow. You can build a model, you can understand. And one of the things I insist on our analysts doing here is that they've got to be able to reconcile, for instance, opening and closing net debt. I'm very old school in that, which is that my view is that, look, if you don't understand where the cash flows of the business are going, you don't understand the business. I think the starting point is, you've got to get some of the basics, which is you do need to be able to read a basic level. I don't think you need to be a qualified accountant or anything like that, but you need to understand what P&L, balance sheet and cash flow are telling you. Then it's actually switching the approach, saying, look, you can talk about the business, but actually you need to be thinking about the business in stock market terms. The example I preach to all my young associates is a stock like Apple, which is $1 trillion market cap, does many things, whether it's iPhones or AirPods or the computers.
Moving into banking now, potentially.
Yeah, exactly. There's lots and lots of things, and their tax position, and so there's a lot going on with Apple.
Yeah.
But really, I think the market's relatively simple, which is, yes, you want to get to know the stock and want to get to know the detail, but typically there's only 4 or 5 things that tend to drive a stock. And it's really trying to get an identification effectively of what those 4 or 5 things are. So for Apple, typically it's, the thing the market will always focus on is iPhone sales and the iPhone price. That's a huge driver, for instance, of the Apple share price. And I think with any stock, you can start to work that out. One of the things that I would suggest you do is pull up a 5-year history of the stock and have a look at the announcements that accompanies that stock. And you'll work out that there's some things that the market just shrugs off, etc. But there's others that it's quite sensitive to. And it's trying to get an understanding of that. So it's really trying to identify what are the sort of key drivers of the stock, making sure that your model then, or however you're projecting your earnings, trying to reflect those drivers of the stock is something that we spent a lot of time trying to coach the team on. And then what I try and focus on is trying to build what we call domain expertise. So if I have, for instance, an analyst who's starting in the tech sector, I mean, the tech sector is a very big church, for instance, and lots of things, but we try and build pockets of domain expertise. So, whether it's gaming or cloud computing, etc., we would have a go at building those domains. And domain expertise means that you're starting to build a network with the companies in that space, the investors, the most important investors in the space, but also just other sources of information. There's a rich source of information. There's lots of noise. So you're trying to work out the sensible commentators in that particular space. We'll tell you a story of how that sort of came to bear. It's dated, so I don't mind talking about it. But two oil companies, Amex and Dominion Petroleum, and for some of your listeners who've got long memories, I'm sure they'll remember them, but they were exploring for oil in East Africa around sort of Tanzania. And we're kicking the tires on Dominion Petroleum. I happened to have a chance conversation with the then chairman of Amex, who was here. And it was a 5-minute conversation where he said that the things I'd focus on are the fact that they got the acreage last. So everyone else had a look and they picked up what was left over, which suggests that it's probably less prospective than everything else. He told me I'd be wary of the convertible bonds because the dilution risk is big. And then he told me a story of when they traveled, that the two CEOs would board a plane and one would head into first class and he would head into, it's small things like that you pick up within the industry and that, I think, is the benefit of domain expertise, which is that many moons ago, when I was building materials analyst, I used to cover a company called CRH, which is well known. And the then finance director jokingly referred to that sort of approach of peer checking as the web of cross-checking lies, right? It's that, but it's important as an analyst or someone who is trying to understand the space of trying to build that network. And it's a very deliberate approach. What we try and do is start mapping out, look, who are the important players in this particular niche. Let's start listening to them. Let's start getting to know them. Who are the important investors? Let's see what they're saying. And suddenly, I think your picture and your knowledge of a particular topic company tends to become better than others.
Yeah, absolutely makes sense. What you've just summarized there is almost a blueprint for anybody to either get started in analyzing stocks themselves or get better in focusing on those sort of areas. Yeah, fantastic. So what does Edison Research do then? How does it benefit the private investor then? If someone's listening now, what is it that Edison Research do for them?
Firstly, let me start by saying that I'm a great believer in equity research or research. I think if you want to quickly bring yourself up to speed on a company, yes, you can look at report accounts, etc. But there's nothing like a 20-page document that tells you everything you need to know about a particular business, how it fits into the industry, who its peers are, put together by an industry expert. So I think there's a lot of value, and it's not just for the investor. There's a whole stakeholder community who consume that kind of content. The challenge, I think, for the equity research industry, and this predates MiFID II, is that it's becoming harder and harder for the traditional way of funding it to deliver equity research. So the asset management community is under enormous pressure. So what they're able to pay out for services has been declining over 20 years. There's a lot of reform currently in the UK market, which is trying to look at this. At the heart of it, there's this long-standing issue, which is it's getting harder and harder to fund research. Today, there's a view of the only way you can run research teams is if you can have a broker retainer or if you're prolific from a sort of fundraising primary perspective, but not everyone can do that. There was a gap opening up in the market, and I happened to come across Fraser at the point when he was setting up Edison back in 2003, 2004. Spent a little bit of time with my sort of former heads of research at Goldman talking through the idea, and ultimately bought into it with the understanding that the change in the model was that we get companies to fund effectively the research over the course of the year. It's an annual retainer. And the reason it's an annual retainer is that I think firstly, you want continuity of coverage. I never want to issue just a one-off piece. It's not about being sensational. And then I understood very early on that there is that principal conflict of a company is paying you to produce research. It's really important to us that it's credible to the end user. We put a lot of time and effort to make sure that the research is balanced in its approach. It's highlighting both risks and opportunities, that the numbers are sensible. the way we value businesses are sensible. And at the heart of it is really this view of, look, we want to democratize access to that kind of information. It shouldn't just be the domain of institutional investors. We want a class of investors to have that kind of information. It's not a rated product, so we don't put buy, sell, hold on it. Part of that is that by making it available universally, what is right for your granny and what is right for a 25-year-old in terms of risk tolerance is very different.
Very different.
But the information that we're providing should help them decide as to, is this something I want to buy into or not? That's where the origin of the business started, which is that we produce high quality content on listed companies. It's got much bigger than I ever imagined it would be. So we work with about 300 companies producing that content. It's internationalized. So it started with the UK heritage, but we write on companies on 28 different exchanges, North America. And it's moved away from where we started, which is covering small cap companies. We work with some very large companies today.
Yeah.
Melrose, Wheaton Precious Metals. We write research on those companies, Dowlays. And part of that, the reason is that I think companies are starting to understand, which is good for your audience, that actually the retail community is an important stakeholder community and they ought to have access to information. It's not the only reason that, they get research from us. They also want to make sure that they're accessing the private wealth management market, the global institutional market, et cetera, at the same time.
Yeah.
Alongside that, we help companies meet investors and we roadshow them to investors. And we are doing much more in the way of actually taking content and digitizing it now. And that's a recent sort of journey for us in the last couple of years. We're doing much more in the way of audio-visual content, pushing it onto digital channels. A really great stat that popped up last week. We have a NASDAQ listed business which serves actually the Chinese financial community of both sort of healthcare and financial services. And it was a SPAC. No one really knew about it. We put out an introductory video of this business, which got 2 million page impressions or to 2 million views effectively. So when you get it right, it's really powerful in terms of just the number of people who want to access that kind of information, who are hungry for that kind of information.
Yeah, it's a balance, isn't it? Because as you said, somebody's got to fund this research, and over the years it's become difficult in how it traditionally once was. So the companies are now funding the research, but then you've got to balance the right information being presented to the retail investor, because if you're just promoting, say, a company, then, and over time those companies don't turn out to be what's been promoted or wrote about, then you've got no audience, then you've got no business, you've got nothing to say to these companies. This is our audience, they like what we write.
Yeah, that's that. We run lots of checks and balances. I think at the heart of it, I think that you've got to get the culture right. We have a team of analysts who, most of them are former bulge bracket analysts. They care about their names and their reputations.
Yeah.
And don't want to say things that are going to embarrass them, and it can hold their own. I think that the toughest thing is building that sort of ethos of, look, we want to write good quality into the content, things that we believe in for the market. I also think that there is, to a certain extent, there's a self-selection bias in what we do, which is if you're a company and you think you're going to have a series of profit warnings, probably the last thing you're going to do is get someone to
come and
speak
to you guys.
I think most companies that come to us feel that their management teams feel that actually we're misunderstood. The value of our business is not appreciated enough.
So where can people access this content and information, and where can they read up about it, learn about it?
So they can read up on it on our website. It's free to access. You don't need to register.
So it's just freely available on the website?
Yeah. So go to www.edisongroup.com. Edison is just with one D. And you can navigate by sector. You can put in the sort of name of the stock, etc., to see all the content, etc., that's there. We've got a LinkedIn page where we feed things through on as well. Two things which I think would be useful to your audience. Firstly, I do a fund manager interview series called Vantage, and I get managers on typically fortnightly to just talk about their views, where they come from and how they go about learning their trade. And I've been doing that for the last couple of years. And I think if you listen to those regularly, there's actually quite a lot of information and education in those. And more recently, I've actually launched a series actually for the retail investor, something called Finfluencers, which is focusing on the names who the retail investor tends to follow. So my first guest was John Rosier, the people. I've just had Darren Nathan, who's the head of research at Lansdowne, and I'm sure I'm going to get you guys on as well.
Yeah, great. I will make sure all those links are shared in the show notes below. So anyone who's interested, all the links will be there. Scroll down, a link to the website, YouTube channel, LinkedIn page, and enjoy what Neil's been doing for the last 20 years. Thank you, Neil. Really appreciate the time.
It's been a pleasure. Thank you very much, Lee.
Yep. Cheers. Thanks.
Bye.